Do property values continue to increase in spite of the two biggest negative market factors? Stay tuned for our monthly update. Well, good morning and welcome to Note School TV, where today we will be going over the monthly update. Guys, you have chosen that our monthly update is the #1 show of the month. So thanks for letting us know that, and thanks for watching. Having said that, make sure and like Note School TV and what you see. Make sure and subscribe to our Note School TV channel, and make sure and go ahead and hit that bell notification so that you will be notified when we go live. Every Wednesday at 11:05 a.m. Central Time. And if you would like to know more about what we do at Note School TV and what is going on in the note space, in the real estate space, creative financing, and if you simply just want to close more deals, make sure and check us out at noteschool.com/TV. Again, noteschool.com/TV to close more deals. So without any further ado, I am going to bring on our fearless leader, our chief visionary, and just all around smart guy, right? Mr. Eddie Speed.
Hello, Joe.
Good morning, sir.
How you doing?
I am doing great. It is a wonderful morning, and wow, I'm just excited to do the update this month. A lot of stuff going on.
Yeah, Joe and I start out with about 50 subjects, and we spend a good bit of time paring it down. And so I think what we've done this month, Joe, is pared it down. And so we're going to use the iceberg analogy, Joe.
I love that.
And what's great and what's not and what affects it. And let me say this. Let me correct you. First of all, I'm not smart. I am seasoned. Okay? I'm not smart, because you couldn't make as many mistakes as I made in the business and be smart. That's impossible. Right?
Eddie, can we just say country boy smart? How about that?
Yeah. And understand, what we show you guys is what we internally gather as a company on a daily, weekly basis. We're just giving you what we pay attention to, right? And we're paring it down and looking at it, and we're trying to make a decision, but it's not like we can absolutely come in here and say, here's exactly what it's going to be, because Joe, we've never lived through a pandemic before. And the truth of the matter is, if I told you that we're going to have this virus, it's going to shut down the whole country and the whole world.
Yeah.
And Joe, as a result of this, real estate is going to go crazy, escalating in value. Would you believe that?
I would have not in a million years, right?
Well, I've been doing it 40-something years, and I wouldn't have believed it either. So we're just trying to read the tea leaves, and we're just enjoying that you guys go along with us. And as Joe said, this is the most popular episode that we do every month. And so hopefully we're adding some value, and we've done a fair amount of research. We're really gathering other people's information. Mm-hmm. So we're just kind of showing you a perspective. So let's use the old iceberg here. Let's talk about it. Oil and gas prices are down.
Yep.
Raging residential real estate market, definitely happening. So what's not so good? Joe, you alluded to it. There was two negative factors in the market.
Absolutely.
And are any of those negative factors going to have any dent in it? Let me say this. There are some bargains in a raging market.
Absolutely.
Hint, hint. Those bargains are probably related to negative factors.
Unfortunately, yes, Eddie.
Okay. So first is the big news that nobody puts as the news. Nobody makes reference to it. I read posts, blogs, data. I do, Joe, you do, several of people on our executive team do, literally on a daily basis. Nobody referring to real estate even blinks an eye talking about this thing right here. 2 million loans aren't making a payment.
And Eddie, this is something you got to dig. You got to know where to dig to find it, because it's almost like it's buried, right?
Oh, you mean like it's kind of meant to not be discussed?
I think that's not a conspiracy, but maybe.
And by the way, we show you where we find this information, so you can you can track this stuff yourself along the way. Burnout landlord factor, I think, is still huge. I think the burnout factor of landlords and the strategies we teach in that area at Note School are a big deal. I think they serve a bigger percentage of the market than the ones that aren't. Mortgage availability is still in flux, still about, call it 30%. The people that could get a mortgage before the virus can't today.
Yep.
That number is going up, though, Joe, because that only relates to underwriting. It doesn't relate to people that have been walled off because of higher rates and not being able to qualify for the new mortgage payment because of rates.
That's right.
And then rising interest rates. And that is a big deal. And we're going to talk about that and how it relates. So let's get to it, Joe. Crude oil. Okay, little good news there. Talk about that, Joe.
Yeah, that's what we were looking for. Just as the singer said, was it Anne Murray? Sure could use a little good news today, right?
All right, so West Texas crude is down a little bit, Joe.
A little bit.
It's down a little bit, and I don't know what your gas pump looks like. I saw a post on Facebook. I guess somebody out in California is paying almost $10 a gallon. They must have been in Beverly Hills or something.
Must have been. Yeah, we're at about $4 here in South Florida. We're about $3.99.9. That's about as close as you can get.
Yeah, $3.70 is about the for good gas. I mean, some of that stuff they pour water into. You know that. So they can put it up. Yeah. But anyway, about $3.70. I looked yesterday. I knew this was coming up. So anyway, a factor. Okay, so let's talk about property appreciation. So since the Great Recession, 2008, Joe, we have seen an increase in property values that is, just call it, going through the roof.
You know, Eddie, I saw those numbers last night when I was going through these, and look at that, almost $7 trillion in 2021. And that number on that second bullet, that's what blew me away.
Now, what residential property is worth?
Yeah, $43.4 trillion.
Yeah. And by the way, we talk about China and we talk about their GDP relative to real estate. But as real estate goes up, it does become a factor in our overall GDP.
Yeah.
Right. So basically, Joe, the bottom line is it's more than doubled since a decade ago, since 2012. Not much to say about that. Real estate has been very kind. We caught it at the bottom and we rode her to the top.
Well, it's like you've said many times, Eddie, when you were talking about burnout landlords, and that's the whole fact that, the market has been amazing to landlords, to everybody, right? And, well, not everybody, right? But certainly the appreciation of real estate has been good to landlords.
People that have done well managing their rentals or having them managed, the market has been really kind to them. People
really
that have not mastered the management of residential rentals, there's an underlying cloud. And we've got a lot to say about that. We're not going to get off into that today necessarily, but we have a lot to say about that. And we have some solutions for landlords that many real estate investors then learn how to position working with landlords to go work with them. All right. So Joe, let's talk about the numbers, because these average property things, this is as of February. This is a pretty big deal here, Joe.
Well, that home value, you look at what the typical home is worth, $331,533. That's a bunch of money. And then we've got a slide on down in the deck there that talks a little bit more about that, and we'll get to that. But look at the change in the typical home value from last year.
From last year, it is up 32.4%. Right. So, guys, I've been doing this this is my 42nd year in the business. I've never been able to do market updates with these kind of slides. This is great. If you're talking about unprecedented, call it unprecedented.
Yeah.
Right.
We can certainly use that word. You certainly had to pivot as well, Eddie. So you got pivot and unprecedented. Those are the words, right?
Yeah. And the thing is, Joe, this is we're trying to give a global scale of the market. We're not calling the market headed for hell.
Nope.
We're not saying that it's headed to, the trees are going to grow to the sky. We're just trying to gather different pieces of the market so that you can draw some good conclusions of what is important to you. And this is the stuff that we gather and look at. So we're just sort of trying to let you lean over our desk. And let me just show you what we do when we have executive meetings, right? And talk about this stuff.
That's right.
So monthly rent has gone up, Joe. Monthly rent is now an average of almost $1,900, and the typical rent has gone up 17%. So rent has gone up. Now I will tell you this, Joe. The average mortgage payment, this conflicts a little bit with some of the news data sources. The average mortgage payment in the last year has gone up for the same house a year ago. Increase in rates, increase in price combined, the average mortgage payment has gone up more than the average rent.
It really has. I looked at some stuff last night, and it was showing, one feed was saying, $1,409 was the average payment, and $1,800 was and I'm like, no, that was from, and I'm like, no, I'm not even, not valid.
Increase in value and increase in interest.
Yep.
Has affected those combination combined. So pay attention to that. Best markets: Tampa, Florida, Jacksonville, Florida. Your state, Joe, is in 3 in the top 10.
Blowing up, isn't it?
Yeah. Raleigh, North Carolina. You and I just spoke there not long ago.
There, and it's huge. Yeah.
I was in San Antonio last week. Uber driver told me, he said, real estate's on fire right now.
Yep. I heard that before.
Charlotte, you and I got some very active investors in the Charlotte market.
Yes, we do.
Nashville, I got plenty of friends in Nashville that are in the space, and hot Atlanta, Orlando, of course, and then Austin Austin and Phoenix were kind of 1 and 2 for a while, Joe, and Boise, Idaho.
Yeah.
Right? So it's interesting. Those markets seem to have cooled off, or let's just say it differently, the fire is blowing brighter in another market.
Well, exactly. I think everybody that's, that kind of moved and drove from Silicon Valley, when everybody started moving from Northern California. So maybe it's settled down a bit now, which is not a bad thing, right?
Yeah. All right, let's talk about the negative. This is what we believe. Let me tell you why I believe this matters to us. I'm not sure if it matters to you yet, but I think it may matter to you. Our company, the biggest growth in our company this year is for the now 5th or 6th time since I've been in the industry. We have refocused, and we have a high focus on buying delinquent mortgages.
Yes, we do.
Okay. When I'm talking to investors, when I'm talking to high net worth, accredited investors, people that are just investing with us, not training from note school, people that are just giving us money to go find deals and us figure out how to split up the money and the profits, I say to them, it's pretty simply this. You want to know what the bargain is in real estate? This is a bargain in real estate.
It is.
This is where the discount is, where there's no discount in anything else. I fully understand that it's not on the news, that if you read real estate rags, they're not saying anything about it. Now, if you read what we read, which is distressed mortgage industry rags, DS News, Housing Wire, all of those sources, right? Then all of a sudden you're going to see that, but these people are the ones servicing loans. So they know what the problem is and they're wanting to constantly stay abreast of it. So there's plenty of Black Knight and all of these sources. There's plenty of sources that have a lot to say about it. Joe, it's just not in the headlines of the news.
It's not. And guys, you can go look in, one of the biggest sources that I like to use now too, is pointed out by Darren Bloomquist a few weeks, that Philadelphia Fed really puts out some great, it is what it is, right? There's no fudging it.
Now look, we fully understand we're at the end of March, and you say, well, Eddie, why are you printing something that's January 7th? Okay. These reports are delayed, right? Joe, this is a brand new report that came out within the last 2 or 3 days.
That's right.
They are delayed. That is going to be the case, but we're following the trends. And believe me, there has not anything measurably happened. These numbers are slightly up a little bit, Joe.
They are.
Right. So these are loans that are in forbearance. Okay. They're in forbearance. The forbearance is basically a legal agreement that says you and the lender have signed an agreement that you're not going to pay. And there is the tailing off of loans in forbearance. And see that angle of my hand going down?
Yeah.
Forbearance is rolling off the backside.
That's correct.
Joe, there's about just under 800,000 loans left. And we're going to talk about how those loans break down here in a minute. So keep in mind, there's about 800,000 loans in forbearance. And Joe, here's a pretty clear slide of showing how this whole party started. Yeah. It started out with a big number of loans, didn't it?
Yeah, 8.3 million. And if you look at that 787, so it's dropped 90%. But what that left us over with is 800,000 loans.
Yeah, so we have we're going to talk about two things. We have delinquent loans that are in mitigation, and that's a big piece of the market, Joe. Right? Currently, loans that are in forbearance in mitigation, 781,000 loans, just under 600,000.
That's right.
Okay, Joe. This is an important fact. So follow along here, me as I underline in red. 781,000 delinquent loans and loss mitigation. Joe, here is the punchline. Okay. 418,320 of those loans are not making a payment. So they had a loss mitigation agreement. They did a modification. Joe, half of these loans, more than half,
75% of these loans.
Yeah, 75% of these loans aren't making a payment.
That's right.
Okay. So understand this is delinquent inventory in the mix.
Yeah.
It becomes delinquent inventory. The second factor is, Joe, up here, these are delinquent loans, a lot not in loss mitigation, and it's still a pretty big number, right? It's the difference between 580,000 lows and 800,000 loans. So there's a pretty good mix of these loans in that bucket. So these are loans, Joe, that are not in forbearance.
Yes.
Okay. We talked about loans that are in forbearance. These are loans that are not in forbearance. So let's just kind of go to the bottom line here, Joe. Number of properties that are 30 days more and delinquent and they're past due or in foreclosure. This is the combination.
Right.
Joe, that's almost 2 million, right?
Right.
1,946,000.
Yeah.
Now I know that graph is a little bit, fuzzy, and that's because we did not want to even make a chance of mistyping the number.
Right.
Right. I mean, that's straight off of the Black Knight report.
And Eddie, every one of those arrows are pointing down, but still there's where you are. And that doesn't include the forbearance stuff, right? So you plop another 87,000 on top. That's a big number. We've got a lot of inventory to work with.
you can circle the wagons. It's north of 2.5 million loans.
Yes, there you go.
Right? That's what the number is. This isn't 2008 all over again, but let me just tell you something. The average number of loans that are foreclosed on per year from about 2016 through 2018 was about 35,000 loans a year.
That's right.
Then 200,000 loans a year.
Right.
Let me write that down so we get our numbers straight.
Yeah.
So every year, 2016 through 2018, there were an average of about 200,000 foreclosures a year. Okay. 2019, now this is adjusted for the first 2 months. Okay. 2019 through 2021, that's 3 years, Joe.
Yeah.
There were about 35,000 foreclosures a year.
Now, why is that, Eddie?
because of the blocks,
That's
because
right.
of the state and federal and county and city moratoriums.
That's right.
So, Joe, here's the thing. To get back up to the normal, we're going to have a big escalation to wash through this inventory.
Yes.
Joe, I don't know if you know this, but this number is higher than this number.
What is that, about 10 times? Almost? Yeah.
Yeah. So understand, why are we excited about non-performing notes? Why do we call them a bargain in the market? Is there's inventory. It's just simple as that. It's inventory. Okay. So are these loans trading? Are they coming off the block? And Joe, talk about this trade right here.
Well, this is it's one of the funds out there, Mortgage Industry Advisory Corporation, and here about 2 weeks ago, we got this announcement. It was the middle of March. Ginnie Mae backed whole non-performing loans, selling $1.1 billion in that's in unpaid principal balance. So this is not what the properties are worth. This is what the balance of the loans were. And interestingly enough, Eddie, half of those came from 6 states: California, New York, Florida, Texas, Maryland, and New Jersey. And so you look at the average weighted, the coupon rate, the interest rate was 4.145%. And the 45, so this is 4,512 loans that are being offered by this undisclosed seller, but MIAC is the one that is doing this auction on these loans. Yeah.
All right, Joe, newsflash. This is less than 5,000 loans.
Out of, what did we just look at?
1,950,000.
Right.
This is a drop in the ocean.
Yeah.
But it does equal $1.1 billion.
Yep.
Think this is something. Now, Joe, if you're asking me, or you're asking our executive team, why is this not in everybody's eyesight all the time? I have no idea. I'm just saying to you that we've observed it. You've done enough. You and I've done enough speaking at significant real estate investor events. And when we put this data up there, they're like, oh my God.
Yeah.
I mean, we've seen it enough to know that this is just not commonly talked about. Obviously, this is why we talk about it. Okay, so let's talk about other things, Joe. Let's get back to appreciation. One thing I will say, when I read all of these articles, Joe, and I'm not calling for a real estate crash.
No.
Right? But when we read all of these markets enter uncharted waters. I've never seen them even refer to delinquent mortgages.
Yep. Not once. Never. Never.
So understand, maybe we're making too big of a deal of it, Joe. Maybe it's not worth mentioning.
Well, Eddie, here's the thing. We can keep our informed group, right? We can talk about those, and we can go out, and let me tell you something, Eddie. Our note school folks are jumping in with both feet. We are seeing a pickup, just in our space of, folks that we've trained.
Joe, let me tell you this. If you're buying delinquent mortgages, escalation in real estate values is a good thing.
Absolutely.
right?
Keeps
So,
going up.
so if you're buying delinquent mortgages and your collateral's going up in value, nobody can tell me that's bad. All right, Joe, Zillow predicts growth this year of just about 17%.
Right. And they were talking a couple of weeks ago. You and I were talking on an episode, and about it's going to cap out in May at about 22% is what they're saying. So, and you got to realize that as the Fed won't meet again until the middle of May, right? And then this is the spring home buying season, which is the busiest of the year. And so, yeah, it's going to peak out that's what they're saying, right? The data is saying. So about 22% in mid-May, and then still it'll kind of flounder around. But look at that. By the first of next year, we're still going to be, and this is a forecast, right? Forecast. No crystal ball, rear view mirror, right? 17.3%. That's
Okay.
off of 18% last year.
All right. So, Joe, you mentioned two negative factors,
right,
related to real estate values. And would they affect these projections? One of which we've already discussed, delinquent mortgages. Right. Now, we see delinquent mortgages as an opportunity because we're in the note business, right, and we're buying delinquent mortgages. Okay. Inventory and rising real estate values are two very positives for that business. And we have a lot of people in note school that are trending in that direction. Second thing, though, Joe, that is a negative factor that we don't really know where people are going with it is that the rate soars.
Yeah.
Right. And we're close. We're close to we're working up close to 5%.
Eddie, let me just say this. I did some research on Friday, and a year ago, rates were 2.65 for that same 30-year fixed.
Well, that's pretty amazing.
Yeah.
I mean, that we're having the conversation where it was March of 2021. Is that correct?
That's correct.
2.65%.
Yep.
And then March of 2022 is 4.95.
And that last bullet point there sums it up, Eddie.
Both rates and higher prices make it 20% more expensive in your payment. That's why I said payments are growing faster than rent appreciation. Look, you're reading a lot of information. You're hearing a lot about inflation. You're hearing a lot about supply chains. You're hearing a lot about escalation in values and hard assets and so forth and so on. We're just giving you things to really start paying attention to that really could matter in your decision.
Exactly.
Right? Listen, Joe, if you and I thought we had the crystal ball and we could nail it, we just go on and do that.
That's right.
Right? We're trying to read the tea leaves just like everybody else. Okay, Joe, let's talk about this.
So this is pretty telling here, Eddie. $321,634. Just not a play on numbers. The value of a typical U.S. home in 2021, an increase of 52,667 from 2020. That figure was slightly higher than what the median U.S. full-time worker earned at $50,000 last year, just before taxes. So $52,000 increase from 2020 to 2021, and you know that when you slap yourself right when you look at that and you think about it, you go but then you look at what you just highlighted in green there, and you go, wow, when does the how do
Joe,
people
what
are people going to do?
Does that mean that the guy that owns this home and has the average home and the average income, does that mean he made more money in his house going up in value last year than he made working at his job?
Well, only about $2,667. But here's the thing. How does he capitalize on that, Eddie? If he sells it, what's he going to do?
Yeah. Where's he going to go?
Where's he going to go?
All right, Joe, let's talk about this.
Yeah, this inventory piece here, Eddie, this is latest from NAR, National Association of Realtors. And we look at the blue line, and that's on the left side here. And this is the year-end inventory change. And then we look on the right side there, and then we look at the number of months of supply. So total. Now this is national. This isn't just a region. This is the total inventory as far as National Association of Realtors, MLS, right? Multiple listing service shows at 870,000 units. A healthy market, Eddie, you've said it many times, is somewhere north of 2 months of inventory available, and this is nowhere near what really needs to happen, right?
Yeah. So once again, if you're wondering why there's all these projections of real estate values, it is simply supply and demand, right? Yeah. Housing inventory. This is your headline right here. Housing inventory at the end of February totaled 870,000 units. It is considered before the virus, a healthy inventory of listing and sales was 2 million houses. Right. That was considered to be a benchmark. So supply and demand outweighing, now listen, Joe, does 2 million loans where people have had to resolution either to sell or move on or do whatever, does that affect the inventory? I think probably it does affect the inventory.
It does.
Right?
It does.
But once again, I'm acknowledging to you that there's a lot of industry experts that aren't making that into the equation.
Right.
Possibly they've missed it. Possibly they've already thought about it and disregarded it.
Yeah.
What do you think?
Well, it is not insignificant, Eddie. When you've got inventory figures, you look, Eddie. There's 53 million. We just saw this on a chart here on a slide a minute ago. 53 million mortgaged single-family homes in the U.S. Right, and there's 870,000 available. Yeah.
Okay,
that's the scary thing right there. That.
All right, let's talk about a factor. And the reason we are concerned as a company that we in doing this business, what we're concerned about is affordability.
Yep.
Right? Because if groceries go up and if gas prices go up and if vehicles go up and if clothing goes up, then all of a sudden, then if you don't have a salary increase that matches that, then all of a sudden this growth in rentals has to stop because, Joe, there's only so much money to go around.
That's it.
Let's talk about this.
Well, look at the stair step there, Eddie. I mean, it never stops from February of last year. Look at that, from 1.75. This is just in a year, goes from 1.75 to almost 8%, just a tick under 8% in 12 months.
Yeah, I mean,
we're all feeling it.
There's no doubt. I mean, when you really look at it, as you said, I mean, it's even going back from 2020, we were seeing it in 21, but right. Clearly to go look at it within the confines of this year, then once again, just early this year, pretty much painting a picture. Joe, do you think that number's real, or do you think it might actually could be higher?
I think it's probably a little bit skewed towards the South, right? That's what I think.
That's what I'm thinking that could be.
Yeah. And then we look at the overall. I think on that next slide there, Eddie. I think that that's the big picture. That's the micro picture, and then the macro is the bigger one, right?
Yeah,
going from several years back. So yeah.
Okay. Even hotter in 2022 is what the headline says, Joe. Tell us what this chart tells us.
Well, this is just, based on what's going on out there in the world. There's a war over in Eastern Europe, and supply chains are still down, and the oil situation is in flux, and we still have labor shortages as far as trying to get new houses built. supply chain as far as housing materials. And this is that's just in the housing sector, right? But then you look at everything else with everything you touch has gone up, and I do believe this. I believe that Wells Fargo, their economists, are pretty smart folks, and I believe they've nailed this. It's going to continue to go up for the time being, and hopefully we'll get some. We'll resolve this conflict. I know they're talking about it, and we'll see what happens. A lot of egos going around over there.
All right. So our friend Dr. David Phelps was actually quoted in this article.
He was.
And a survey of people that are concerned about energy prices related to home buying. Biggest concern, Joe, was appliances.
Yeah. Energy efficiency.
19% of people were concerned about it. But another thing was the commuting distance.
Yeah. Well, yeah.
And people don't want to drive as far to work because they burn more gas. And that's just under 17% of people were worried about that. And then all of a sudden, another factor, Joe, and that is location and what kind of climate you live in.
Oddly enough,
milder climate.
Those top 10 cities that we just looked at, where were most of those were in areas that were sunshine states, Arizona, Texas,
no doubt about it.
Yeah.
So this is all really cool that it really affects the market and things that you do. And I think that, so Dr. Phelps was noticing the fact that, because obviously he has a group of high net worth, particularly dentists.
Mm-hmm.
They're in his mastermind and they're buying income properties and they're trying to look at where to buy and what are people looking for that are looking for rentals.
That's right.
They're buying rentals. What are they looking for? Right. Pretty cool market update. Little quick update here on Evergrande, Joe.
Yeah, we couldn't resist, right, Eddie? We've been kind of following Evergrande for just a little bit, but instead of throwing out their latest numbers, they just decided that they would just kind of keep them a little closer to their chest, right? And then obviously, so the Chinese government, the CCP, goes in and says, okay, well, we're going to seize $2 billion of your assets. So, it's not just here. This is a smaller world than we really know.
Evergrande being a Chinese-based real estate development company, the most written about real estate development company because of their financial troubles. I believe that their financial troubles in China go far deeper than just Evergrande. Yeah. But Evergrande continues. So I love it, Joe. They just said, we just don't think we're going to report anything. We know compliance says we're supposed to, but we think we're going to skip that step. And so the government comes in and seizes a bunch of their assets.
Well, Eddie, the old saying about if it's not in writing, it doesn't exist. Well, I guess if they just don't put it on paper, it's not real.
I'm going to tell you this. I'm going to tell you that I believe 100% that there is going to be a lot more story to come about this company and a lot of Chinese real estate, the Chinese real estate business overall. And Joe, I think the effect of it is, to draw a point, it's not that we're investing in China, it's that China is investing here. And I think that there is a lot of markets that can be pretty significantly affected. They used to say, and I haven't seen a report in the last, call it a year or two, but they used to say that about 25% of the properties that were owned, like in Seattle, were Chinese-owned rentals or Chinese-owned properties that didn't even have a renter in it.
That's right.
So they bought here to stabilize their money. So how that affects the market, I don't know, but I think that the China factor, I think we're going to look back. This is a prediction. I think we'll look back and see that this made a difference. So.
And, Eddie, here's the thing. We can say all these things about what's going on in the United States, but at the end of the day, where do most people want to invest throughout the world? They love investing here in the United States of America.
Well, and once again, Joe, this is why This is why that these predictions of real estate values are predicting an increase in spite of some negative factors, right? So that's definitely a case. So, Joe, you had mentioned this before. I'll just show you this chart really quick. This is a chart that shows the percentage increase per month. Now, let me be clear about this. When it's trending down, it's not that they're saying real estate is going down. It's just saying that it's not increasing at the same rate.
Exactly. So it's tipping again, because we know why, right? The Fed's going to meet again. People are worried about rates. The Chairman Powell bringing the POWELL, right? The rates up again, which probably will. So 22%. And then at the end of the year, this time next year, talking about 17.3%.
Yeah. So understand this is, and I'm making some decisions on real estate we own for this very thing right now. So we are not disregarding these projections. We are considering these projections, and we're also considering other market variables. And once again, we're not trying to go call for a 2008 or anything, but there's a lot of delinquent notes, as Joe said, about 10% of the delinquent notes. So
Eddie, why don't we run a quick commercial for our one-day class, and then we'll sign off here.
Let's do that. One-day class, we're going to talk about the voids in the market and where the bargains are in this hot real estate market. Stay tuned.
Well, hello, everyone. It is Brian with the teaching team here at Note School, and I'm excited that I get to be the one to invite you to the upcoming Gold in Notes class. That's right. It is a one-day deeper dive class that we call Gold in Notes because of how valuable this time spent is. This is a full day that we really get to dig into the nitty-gritty, the whole world of creative financing, not just how to acquire more deals, how to get access to more capital, how to defer a lot of the taxes for us as well as for the sellers that we're talking to, and really learn how to create your own notes. And really, once you learn how to create your own notes, this is really where we spend an entire afternoon really pulling back the curtain on what the note business is, from wholesaling notes, buying and holding performing notes to really build your wealth. I'll even show you a strategy called partials, which is by far the best wealth building tool I've ever seen in the real estate space. And we're definitely going to spend some time talking about non-performing notes, which is by far the biggest opportunity in today's marketplace, solely because of the events that have happened over the past couple of years. This is when people are not paying their mortgages, and we're going to make a lot of big money from these bad debts, and we're going to help a lot of people get a second chance. It's an absolutely fantastic day. Come spend a day really dig in and discover a lot of this stuff so that you too can start building your wealth. It's a day meant to really be engaging. Bring your questions, bring your comments, bring your business problems, and we will see you there.
Okay.
Right.
Seizing the market opportunities, Joe. That's the message of the year, right?
It is.
And that is, in a hot real estate market, where are there voids? Where are the bargains? Where's the discount?
Yep.
And how does it relate? So I hope that this market update today has been great for you guys. We don't try to make this show last exactly any time. We just go gather the most important data and we try to talk through it. I hope this is meaningful to you. As Joe said, remember, if you like what we're doing, do the like it, subscribe it, hit the bell, make it give you a notification. And Joe, we're just going to keep doing what we're doing here.
You're exactly right, Eddie. And you're where you need to be. Remember, non-performing notes and buying and selling, burnout landlords buying on terms. That's our goals this year. Eddie, I think that we'll say, like we do every week, right? We'll see you on the other side. We'll see you next week. Thanks, guys.
Bye-bye.